This is Fintech Insider News, and this week, Stripe just made a record-breaking purchase. The US gets open banking regulations, sort of, and Minna Tech have partnered with Capital One, and they're here to tell us all about it. We'll be discussing all of this and more on today's show, so don't go anywhere.
Are you struggling to close deals? B2B selling is tougher than ever, and that's why we want to tell you about LinkedIn Sales Navigator. LinkedIn's Sales Navigator is a sales intelligence platform that helps professionals effectively prospect and engage high-value customers, drive higher revenue, and increase sales performance. Sales Navigator helps you target the right buyers, surface key signals such as job changes or which accounts you should prioritize, and shows you hidden allies so you can find those buyers who are most likely to convert. Fueled by LinkedIn's 1 billion member platform, Sales Navigator gives you the most up-to-date first-party data, enabling you to unlock conversations with the people who matter. Right now, you can try LinkedIn Sales Navigator and get a 60-day free trial at linkedin.com/fintechinsider. That is linkedin.com/fintechinsider for a 60-day free trial. Let LinkedIn Sales Navigator help you sell like a superstar today. Just go to linkedin.com/fintechinsider and get started.
Hello and welcome to episode 909 of Fintech Insider. I'm Laura Watkins, Director of Media Marketing at 11FS. I'm joined this week on Fintech Insider News by some great guests who are here to break down the biggest stories from the past week in fintech and financial services. First up, a warm welcome back to my good friend, co-host and 11FS colleague, Ross Gallagher, Head of Ventures at 11FS. I'm not actually sure we've ever done a podcast together. How are you?
I'd be absolutely horrified to think that we hadn't done one together, Laura. If it is the case that it's the first one, then it's great to be here. It's great to be here together.
Yeah,
I'm doing well. I'm really looking forward to the show.
If we have done one, it's not for a very long time, so it's good. It's good to be back on mic. Next up, making their Fintech Insider debut, we have Navi Singh Randhawa, CFO and CCO at Minna Technologies. Welcome to the show, Navi. You've got some exciting news that we'll cover later on, but in the meantime, please tell us a little bit about yourself and what you do at Minna Tech.
Thank you. Thank you for the introduction. Minna Technologies, we are the global market leader for subscription management embedded in banking apps. We partner with tier 1 banks, fintechs, and merchants, and today we reach over 120 million global customers. About me, you know what I do at Minna. Prior to Minna, I was CEO and a founder of a Series A HR tech venture and actually started my career in banking.
Amazing. Thank you. And we're going to hear much more about that later on in the show. And completing our lineup today, it's a warm return to Fintech Insider for Ruth Foxe, General Partner at Foxe Capital. It's always great to have you on the show, Ruth. How is life at Foxe Capital and for you more generally?
Life is great. Making a lot of investments. We are focused on early stage. We do a lot in financial services, focusing on other sectors as well. So very, very busy with the current portfolio. Some great announcements coming soon on new investments and actively deploying capital.
Amazing. Well, definitely keep us posted on that. And that kind of VC background is definitely going to be useful in the discussion of our top story this week, which is Stripe acquires stablecoin platform Bridge for $1.1 billion. The story was in Yahoo Finance and generally everywhere. The fintech giant Stripe has acquired stablecoin platform Bridge for, as I said, $1.1 billion, which makes it Stripe's largest acquisition ever and the most valuable deal in the cryptocurrency industry so far. Bridge has become one of the key software solution providers enabling enterprises to process stablecoin payments. Stripe brought back its cryptocurrency payment functionality for businesses in the US earlier this month, supporting USDC transactions on multiple blockchain networks. The deal marks Stripe's ambition to expand its digital payments infrastructure even further from an already strong market-leading position that had it valued at $70 billion. So, Stripe did a thing, and they don't do things by halves. It's, as we said, both their biggest acquisition and the biggest blockchain acquisition at a stroke. Ruth, what was your thoughts on this? Some commentators online have compared it to Facebook acquiring Instagram back in the day and what each brand brought to the table for each other. What are your thoughts here? Is that comparable?
I think it is. So just to kind of take a big step back on stablecoins and why they're so important. Stablecoins are a type of cryptocurrency whose value is pegged to another asset. Usually it's a fiat currency or gold. And you mentioned USDC, which is currently supported by Stripe. This is a coin whose value is pegged to the US dollar. For those people in America, this isn't that exciting. And I think that in the US and in the US banking system, we've tended to not understand how important stablecoins are to the rest of the world that aren't naturally by default operating in the world's reserve currency. But stablecoins are this incredibly clever way to get access to the US dollar and to get access to a currency which is, as the name suggests, stable. This is super important for Stripe because they have been vocally, well, first of all, not hostile to crypto for these types of use cases and actually positive about how crypto payments rails can be important and necessary for critical payments infrastructure. This is really doubling down on and investing in that infrastructure to better serve their customers, both in the US and I presume abroad.
Yeah, absolutely. And Ross, you were kind of nodding there. What does this sort of say about their commitment to diversifying their offering? Stripe famously want to change the GDP of the internet. Does a move like this kind of, move the dial on that ambition?
I think it does. I think it's an amazing sort of mission statement, wanting to change the GDP of the internet. There's something special when a company can have a mission statement that is that ambitious and yet it's credible. I think if anyone's going to do that, Stripe's probably a leading candidate. And I think all of the points that, I agreed with everything that Ruth said. I mean, the great thing about stable coins, I suppose actually a limitation of cryptocurrency more generally when it comes to becoming a foundation for financial transactions, of course, is the volatility in price. Stablecoin strips all of that out. And so it becomes a much more realistic mechanism for making payments. And I think when it comes to international payments especially, when you look at the hundreds of years old correspondent banking model that is enormously frictionful, that has all sorts of issues around timings and risk and trust, stablecoins is a really good way to sort of improve that experience for all parties, right? It's kind of win-win-win. And I mean, the scale of this, the figures that you're talking about, Laura, I think are just incredible. This acquisition hasn't come completely out of the blue and that there was a trend, right? You mentioned about the USDC. Stripe also have a partnership with Coinbase. They clearly are investing in cryptocurrency and stable coins for the long term, right? And I think that is exciting.
Yeah, definitely. And obviously stable coins have stability kind of baked into them. That's sort of the point of them. But some of they still come with complexity of their own. But Bridge is supposed to take a lot of that complexity out in the same sort of way that Stripe does for fiat payments. So kind of easing the way at sort of both ends. What's your thoughts on that, Navi? You were kind of nodding along to Ross's points there in terms of the kind of ambition of the piece from Stripe.
Yeah, I think this is the most interesting piece for me in this is that the line between the fintech and crypto is blurring now. So this was very interesting with Stripe coming in, acquiring a crypto company. This obviously is not the first one coming forward, right? It's the first main one. We obviously know Visa and Swift, they are building their own native solution, or Robinhood acquisition of a crypto exchange, or PayPal crypto solution. So this is definitely becoming mainstream. And this is just a stamp on that. So it's very interesting you compare this to Facebook, Instagram acquisition because it seems like it had all the ingredients to be of the same impact on that side. As a fintech ourselves, right, I think all we care about is we want to transfer fund anywhere in the world 24/7 without any cost, right? So if this platform can simplify all the complexity that has always existed with crypto, I think this is a step in the right direction.
Yeah, absolutely. And to your point, like the blurring of what is crypto and what is fintech are kind of, they were kind of very separate camps. This is sort of bringing the two together. Could we see more of this? Do we think this, you won't see them in two separate camps anymore? Crypto will become fintech and vice versa.
I completely agree, Laura. I think it's a really, really interesting, if you think about crypto rails, when you relate it to any sort of underlying technology, really it's an enabler, right? And it's an enabler in terms of the propositions that we can build on top, and ultimately, I suppose the service outcomes that we can solve for customers, the experiences that we can deliver for customers. And so, look, what I don't want to to do is get too carried away, right? This doesn't, for me, necessarily say that everybody's going to look at what Stripe is doing and go, we want to do this as well. I think that would be a bit of a fool's errand. I think we shouldn't feel that because Stripe can do something, every company can do something, right? There is something especially unique about Stripe. But if what comes out of this is, laying better technological foundations, bringing these types of technologies into the mainstream and allowing other providers to build on top of these technologies and provide better and more innovative propositions, then I think that is very exciting.
Definitely.
Just to jump in there, right? I think the most interesting piece here is that the company is just 2.5 years old. They've grown quite a bit, like in the last year or so. So for me, I'm obviously have to read up a lot more on this, but this is more of an intent from Stripe to bring something mainstream. And I'm very interested and curious to follow this all the way. Like, I think that from the intent point of view, they've nailed it, right? They clearly understand, even if you read the statement from the company, Bridge, it talks about Stripe clearly understanding the challenge with the current payment infrastructure, right? And this acquisition shows the intent to do something new, right? And from that intent point of view, I give a lot of kudos. And as pretty much with all of us, we are watching that how this evolves into our day-to-day life.
Yeah, definitely. And Ruth, kind of building on that point that Ross was talking about the kind of user experience and so on, like moving away from seeing stablecoins as an asset class and more the kind of infrastructure of what they can actually do. Already they're moving kind of $3 trillion on a monthly basis. How big can this go? Is the kind of the rest still to come?
Yeah, I guess I'm going to take a slightly more strong stand on this. I think it's a really big deal. I think that, the majority of all crypto trades are transacted in stablecoins right now. This is a use case beyond speculation, which exists for crypto. We can't do payments in crypto because we have low throughput volume problems. You don't have that in stablecoins. You can do costless remittances with stablecoins. You can move money in such a dramatically superior way. And a $1.1 billion acquisition is a huge acquisition. It's definitely something that Stripe, debated and had, governance conversations about internally. For me, this is obviously, it doesn't mean that the entire direction of the company is shifting, but it definitely feels like a big shift when we're thinking about modernizing the critical infrastructure of payments globally. I think it's really important.
Absolutely. And Ross, on that global piece, sort of, as part of this deal, as Ruth was saying, this sort of isn't that exciting actually in their kind of home markets. It's more that it enables international payments. It says here, it enables businesses who are Stripe customers in over 70 countries to accept stablecoin payments. Like, is that the real meat of the story?
100%. I go back to Navi's point about, where this goes from here. But I think right now that reach is absolutely key. And look, we're nerds. We're sat on a fintech podcast and we're getting really excited about this. But the reality is that for the average user who's using Stripe services to make payments, to move money, really what this means for them is that they can do that much more seamlessly to much more countries than maybe they previously could. They're not necessarily interested around, it's a stable coin and it's this innovative new use case. It's just a better service proposition for those customers.
And I guess that's the point of Stripe, is to make everything really easy. And so no one knows anything else about their KYC infrastructure or their lending algorithms. Like, we don't need to know as customers. What you need is simplicity. I think that the fact of the investment and this evolution of the infrastructure just feels really, really critical and interesting.
Definitely. I'm going to move us on to our next story because that felt like a really good place to end that one. But of course, we will keep an eye on this. The headline right now is the price of the acquisition. It'll be interesting to follow what actually happens in due course. So moving on to our next story, which is that Capital One partners with Minna Technologies for subscription management tools. This was in the papers and other places besides. This is the first major US credit card company to do this. This means that Capital One credit card holders can now view and manage all their subscriptions, like those streaming services trials you always forget to cancel, directly from their mobile app, and it doesn't cost anything extra. The partnership's all about making life easier for customers while staying on top of regulations. Minna Technologies is big on integrating with banks and merchants to help users handle their subscriptions in one place, which makes it more secure and cuts costs for everyone. It's also a nod to the growing trend of recurring revenue models with more emphasis on making subscription management simple, clear, and secure for everyone involved. Obviously, I have the perfect person to tell us more about this. So, Navi, congrats on this partnership. And please, can you just tell us a little bit more detail on how it all works?
Thank you. Very exciting. Obviously, grateful to Capital One for launching this in the US market with us. It's very simple, right? So I'll cover all three angles here. So we are a marketplace. We connect the cardholders, people like you and I, with the merchants, subscription businesses in an issuer environment, right? The easiest piece of this is like the consumer angle. We all know number of subscriptions are increasing, right? Spotify, Disney, Netflix, it goes on, right? People are snacking off subscription. Your favorite show is showing up. You sign up for it. Your Premier League team, your football team is following, you sign up for it. Then a couple of months later, you don't need it, right? And where do we get these subscriptions, right? We physically go to a gym and sign up for service. We go to App Store and sign up for service. We go to a website and sign up for service. It's quite spread out and scattered. A lot of time I will get like managing an individual subscription is not a problem. But if you look at, on an average, people have like 9, 10, 11 subscription. And if you put a household in it, it's even bigger. It becomes a problem, right? But no matter where your subscription is, you're still paying for it in your bank environment. And that's what our mantra is. Where you pay is where you manage. So you can find all your subscription and create the first wow factor from a consumer point of view to give an overview of all the subscription in the banking app and allow them to manage it from there. We often get like, what's in it for the bank? And that's the most interesting piece here, right? So most of the discretionary spend is actually moving to subscription, right? Your day-to-day, you don't engage with your direct debits and your standing orders. It's actually your recurring spend that you're tracking. And on the bank side, the disputes and the frauds linked to recurring spend and subscriptions are so huge that they have to stay ahead of the curve to manage it. And on the revenue side, if you give greater control to your cardholders end up using their card or the bank card as the top of wallet card, right? So it's a great opportunity for the issuer. And last piece of this jigsaw, and a very important one, is merchants who are continuously looking at on and off channel experience. They want to retain customer. They want it easy for the customers to come back, and banks open up a new channel. So what we simply do is we allow users to find their subscription in a bank channel and manage it from there. And by manage, what we mean is allow users to cancel a subscription, give merchant an opportunity to retain a customer without ever leaving a bank environment.
Wow. So, I mean, there's a lot to unpack there, but maybe just as a point of interest, is anyone on the panel going to own up to, being signed up to some subscriptions they probably ought to cancel? I mean, personally, I think I have a surprise Audible subscription that takes me by surprise every time I realize it's still taking money from me. Anybody else?
Absolutely. I think it's gotten even worse because I think my Amex card sort of automatically changes the number for my subscriptions rather than forcing me to cancel it. I used to just get rid of subscriptions when my card expired.
So this has almost made it too easy for you. Now you need a nice, easy way, such as this, to actually cancel them for yourself.
Yeah, as a consumer, it's kind of a dream.
Yeah, I think that's right. I mean, I was thinking about that as well, Ruth. What are the sort of workarounds? And I think, waiting for the card to expire was a typical one. Maybe more recently, people setting up their subscriptions on a virtual card so that they can then bin off the virtual card. And I think wherever you see, those types of workarounds, I think it kind of points to a customer need. And this is great because I think, Navi, exactly to your point, when you're sitting down to think about your finances and where are there areas that you can save, as I'm sure, almost all of us have done, particularly in the last couple of years with this cost of living crisis, you're doing that in the bank environment. And so there's a need there. And so what you're talking about is putting it at the point of need rather than having to come out, all right, I signed up for a free trial. Now it's charging me. Oh my gosh, what was the password that I signed up with? All right, forgot password. Now I've got to go through this whole thing. Whereas what you're talking about is within a couple of clicks at the point of need, you've addressed that customer need.
Exactly. And what is really interesting is that we often miss out. We all understand the fact that we have a number of subscriptions, but what is missed is like how often we need to engage with them. If you go through a subscription journey, you sign up for a subscription, You met a partner, so you want to upgrade a subscription and move to a family plan. You want to potentially going on a vacation, so you want to pause a subscription. You want to cancel a subscription because you no longer need it, right? Or you want to negotiate a better price. They're like 5 to 6 touch points at a subscription level. And if you look at 10 to 12 subscription, that's like 60 to 70 touch points scattered across different channels. And all of this rise to consumer complexity or subscription fatigue, as we call. On the issuer side, it is rising disputes and rising cost of like people calling the bank, my son or daughter signed up for PlayStation, I don't remember the password anymore, right? Or on the merchant side, right? Disputes related to that. We streamline all of that by creating a platform, a simple platform which connects the cardholders with the merchants in a bank environment. It's such a wow factor. The NPS scores are out of the chart. That's no surprise, like the banks like Lloyds, the banks like Capital One, banks like ING, which are like forward-leading banks, like really innovative and consumer-friendly, are prioritizing this as one of the features that they want to bring forward to make financial health of consumer really good.
Fantastic. And can you tell us a little bit more about that sort of benefit piece, if any, for the subscription services themselves? Like, is there any benefit to them, or is it more about putting the power in the hands of consumers?
Good you asked that, right? So Ruth, you gave an example just now, right? That your American Express card expired and you got rid of all your subscription, right? So in a pre-Minna world, right, without Minna, banks were obligated by regulators to stop a subscription, right? So you have a right to call your bank and say that, hey, this particular merchant should never charge me again. And bank as a payment regulator, they have an obligation to do it. But how do they do it, right? They have this blunt instrument which stops the payment. It blocks the payment. Now, that instrument doesn't talk to the merchant. It's basically a guard which stops anything coming from that merchant. Now, think of it this way. You mentioned Audible earlier, right? So if you block Audible, right, merchant has multiple subscription, right, coming from the same source. So Amazon is not just Amazon. It's Amazon Prime, it's Audible, it's Amazon one-off subscription, PlayStation Plus or PlayStation has one-off transactions as well. So when you use blunt instruments like that, it kills everything. And if you have a binding contract, right, you as a consumer, Ruth, I hope that wasn't the case with you, you will end up in a bad debt situation because you owe money, because you signed up for a 12-month service and you simply stop paying. So the real value here is that don't do a blunt instrument like that. Rather, cancel the service you want to cancel and have a seamless way to get back, right? So the user can come back. Merchants are, and this is where Minna is focused as well. So it's not just a cancellation, we are enabling merchants to retain customer at the point of cancellation. So think of it this way, you cancel a membership and the merchant say, hey, would you stay if I give you 20% off? Or hey, would you rather pause a subscription, right? And we see that, a lot of customers choosing that as an option. So the core of it is giving more power and more control to the cardholder in a frictionless way.
That's really interesting. And it kind of, opens up a dialogue as well between the subscription service and the recipient. So it isn't, as you say, just using a blunt tool to shut the whole thing down. It does give the option for negotiation there as well, which is really interesting. Ross, you look like you were particularly interested in that.
Yeah, I was, because I think that merchant proposition is really interesting. I mean, in this instance, by making it easier for customers to cancel, for example, although I know, Navi, you mentioned there were lots of other touch points as well that are equally relevant, it kind of puts the onus on the retailer to make sure that they're engaging the customer in the right way, that the proposition is up to scratch. I think there's some skepticism inherent in all of us that when we think about subscriptions, it's that kind of lazy, like, you hope that we sign up and kind of forget about it. But actually, this puts a little bit more pressure on them to make sure that the offering, that the proposition's really on point. And, again, I think that's just a better outcome for everybody.
Yeah, absolutely. Right. So when we speak to merchants, and if you look at the regulators, right, as well, the click to cancel regulation coming through. And when we speak to the merchants, right, they always prefer a direct communication, a cancellation request to be clean as opposed to a block request or something like that. Essentially, it's about, easy way for the users to go out. And there are many studies and reports on this. If you make it easy for the consumer to go out, it's more likely that they will come back or more likely that they will stay. Any friction you create in that process leads to a bigger decline eventually. So, creating something like this is essentially great for all involved in the ecosystem.
Absolutely. And Ruth, you were nodding along there. Sort of from your perspective, what does this look like on the sort of partnership play as well? Like, is this a kind of a good sign that a big bank and a smaller fintech are teaming up to take on this issue rather than a bank trying to tackle it themselves?
Well, as an investor, I applaud you, and I am, I know how difficult these partnerships can be to structure. it certainly gives you access to a lot of customers. It allows the bank to kind of expand and kind of sharpen its pencil on its PFM solution for its customers, and hopefully they avail themselves of the opportunity to use the service. But I think it's a real feather in your cap whenever you're able to, as a smaller company, make a deal happen with a larger company. And it's always really interesting to observe the conversion rates and the amount of uptake amongst the end users. But this feels like, why not? It's a super valuable proposition to the end users of the bank.
Thank you for saying that, right? Just a couple of things on that. First of all, kudos to Capital One as well, who have been a fantastic partner, wanting to launch this solution together with us as a true partner in a new market. You mentioned PFM, right? And we have a strong view of our product in terms of like, how do we position it? So PFM, for everyone's benefit, is personal finance management. And if you look at the first generation of personal finance management, it was all about giving greater visibility to the consumer. So you can see where you're spending, what you're spending on, how you're spending, a better view of your finances. But we at Minna always took a view of so what, right? If you can't do something about it, what's the point of knowing it, right? So while it's a step in the right direction, we always consider ourselves as a 2.0 of this, right? Like executing, doing the job, right? The job to be done should be done, right? And that's where the management aspect of this was very important. And the network play was very important, that yes, we give visibility, but we help you act on it and have a better financial life, reduce dispute for the bank, greater spend on the card, greater retention for the merchant. So action for us was the core of everything we did.
Amazing. I think that's so great. Like, this sort of the so what element is so important, of like, okay, you've given me all this data, what can I do with it? So yeah, I think that just generally as a mentality is just a great way for everyone to kind of manage their finances, but also for you guys, like as a business, to sort of have that as your mantra as well. I think that, we could probably talk about this all day, but I do have to move us on. But thank you so much for telling us all about that, Navi, and congrats again. And we look forward to hearing more about it in the future. But on that note, we're just going to take a quick pause here and back shortly.
Whether you're starting or scaling your company's security program, demonstrating top-notch security practices and establishing trust is more important than ever. Vanta automates compliance for ISO 27001, SOC 2, GDPR, and more, saving you time and money while helping you build customer trust. Plus, you can streamline security reviews by automating questionnaires and demonstrating your security posture with a customer-facing trust center, all powered by Vanta AI. Over 7,000 global companies like Atlassian, Flow Health, and Quora use Vanta to manage risk and prove security in real time. Our audience gets a special offer of $1,000 off Vanta at vanta.com/insider. That's VANTA.com/insider for $1,000 off.
This episode is brought to you by Global X. Since 2008, Global X ETFs has been committed to empowering investors with unexplored, intelligent solutions. Global X specializes in exchange-traded funds that offer exposure to the artificial intelligence ecosystem, including themes like data centers, robotics, semiconductors, and cloud computing. To learn more about Global X's entire suite of ETFs, from covered calls, fixed income, emerging markets, and more, visit globalxetfs.com.
Welcome back. Before we get into the news, we want to let you know about our latest Insights episode. Kate Moody sits down with Xavier Shea, CEO of the Australian digital bank Up, to find out more about their mission to make banking fun. We're big fans of Up here at 11FS and think after listening to Xavier, you will be too. To listen, just head to your podcast feed, and unless anything has gone drastically wrong, it should be the episode under this one. Right, back to the news. Our next story is that open banking, in inverted commas, rules for consumer data were unveiled by the US watchdog. And this story was in Reuters. The US watchdog, the CFPB, on Tuesday unveiled long-awaited rules intended to drive a shift towards open banking and spur competition, allowing consumers to control and share their own data. As the so-called 1033 rules take effect, consumers will be able to transfer their data between banks free of charge and without obstacles. They will also be able to borrow on better terms, for example, by allowing lenders to issue loans using data held by other financial institutions and to make payments directly from their bank accounts rather than by card. Consumers will also be able to revoke access to their data immediately. First proposed a year ago, the new regulations were 14 years in the making, having been called for in the 2010 Wall Street reforms enacting following the 2008 financial crisis. Larger financial technology companies will have until 2026 to implement these rules, while the smaller companies will have until 2030. Russ, what are your thoughts on this? The US finally gets open banking regulations, sort of. Is this something we should be excited about? Are they late to the party? What's your thoughts on this?
I think both. I think it's maybe something that's a little bit difficult to get excited on this side of the Atlantic because we've had sort of open banking regulations and standards for such a long time at this stage. But is it something we should be excited about? I think it is. We saw even here in the UK really that you need the regulator to sort of push these standards and hold the banks to timescales for this to happen. And so it's good to see that is happening. And I do genuinely believe, we talk back to what Navi was talking about in terms of the previous story. I mean, again, this is an enabler for really great innovation and customer proposition. We've seen that here in the UK, and I'm sure that we'll see it in the US, right? I mean, they love innovation. So I think the potential impact is there. I think, it's good to see it moving.
Yeah, absolutely. And I think some of the key takeaways, obviously there's that timing piece around some of the smaller banks having longer than the bigger ones. The sort of cash flow underwriting for younger and thinner files called out as a benefit. Greater consumer empowerment and data protection was also a big one, as was pay by bank. Ruth, in your opinion, what was the sort of biggest takeaway from these updates?
So I think we'll see is kind of where I'm at. It's really going to boil down to both enforcement and enforceability. Also, there's so much in the execution of how these things are done. And I think that that's something that, we tend to see companies take things and execute in such a way as sort of remaining beneficial to them. There is no doubt that there still exists fragility in the banking system, and a lot of the rules that were agreed following the financial crisis actually have led to even greater concentration in the banking system in the US. It's also just very well known that one of the reasons that London has been such an important hub for fintech and such an important place for banking innovation is because of open banking regulation that was really enforced well for a long time. So I do feel somewhat optimistic. I think that the kind of thin credit file example feels like one of the typical Capitol Hill, like very minority examples of benefits that don't really accrue to tons of consumers. And it's sort of thrown in there into sort of complex regulation to become part of a soundbite. So I guess net proof is in the pudding.
Navi, what were your thoughts?
A lot. I think broadly I aligned. The devil is always in the details. To do a bit of a history here, right? So when open banking came in Europe, right, UK and Europe, red tapes of the issuers became red carpet, right? So issuers rushed left, right, and center to partner with fintech. It was a great opportunity and great timing. If you look at the valuations at that time, which I'm sure Ruth can speak at, they were incredible, right? So there was a lot of openness from the issuers to partner with fintech companies at that time, just because of this. It's not just the open banking of the data that was made available, it's just about how banks have to start thinking about the new way of working. Right. So that change was more powerful, I would say, than the actual implementation of the open banking. In terms of the US doing it finally, right? Obviously, there are bigger companies like Plaid and others which are already doing bits and pieces of that very incredibly. So I'm very interested in implementation, right? If you look at the European market or UK market, there hasn't been a mass adoption of it, right? The open banking still, I believe, is 10 million customers who are using it in UK. So it's not been incredibly high adoption. And having used open banking ourselves at Minna, I can tell why. It's the poor implementation at the bank level. So I'm very interested to see how issuers in US and how fintechs in the US, I hope that they learn from the European market in terms of the spirit of this, and a lot of new companies and a lot of new partnerships evolve. But in terms of the implementation side, I hope they don't learn from here, rather do something much more new and much more better on the implementation of open banking.
Yeah, that's such an interesting point. I think, as you were saying, open banking in the UK is 6 years old, but I hesitate to say only, but it has only got 10 million users, which of a proportion of the population is not that big. Today, in fact, we at 11FS have just released a report in partnership with Go Cardless looking at the success of open banking in the UK and open banking payments with UK merchants. Of a survey, 23% say they are very familiar with open banking, and 48% say that faster payments are the biggest advantage, followed by better visibility and then reduced payment fraud. But the conclusion is that mass adoption is not yet on the horizon. There's a few obstacles in the way, which is probably to your point around implementation, including the need to further develop the infrastructure, improving and harmonizing the customer experience, and a full rollout of VRPs, but also agreeing on a set of consistent terminology so that people actually know what you mean when you say open banking. I think our Director of Research and Strategy, Benjamin Ensor, who co-wrote this report, literally said at the Open Banking Expo event that open banking is a terrible name, for what it actually means and what it does. And so, it almost has an image problem in the UK as well. Ross, what are your thoughts on that? What can the US, to Navi's point, maybe do differently to how things have gone in the UK, or what can they learn and build on from the success or otherwise that we've seen over here?
Yeah, well, I've just been reflecting on Benjamin's point that it's a terrible name, and I suppose actually in practice it is, right? You don't want to think about your bank and your banking information as being open. So that is an interesting thought. On the point about adoption, I think that comes back, and Navi, I think you touched on this a little bit in the previous story as well. I think that comes back to the fact that the customer propositions just aren't really there today, right? I completely agree with you that it seems like we almost got to being able to integrate all of your accounts into a single environment and then kind of stopped. And really that shouldn't be, the sort of limits of our ambition in this space. And we have lots of research at 11FS. We talk to customers quite regularly where they kind of tell us, look, the first step was about, being able to understand my finances. And that was great. Suddenly I could see my net position across all of my accounts. And actually that was interesting, if not necessarily useful. But then from there, they really want to jump off very quickly into actually being able to control their finances and do all of the things, Navi, that you've talked about that you guys are doing at Minna so well. And so Laura, to your point, I mean, if there was something that I would suggest that they learn from, I think it's really try to understand, okay, again, this is an enabler, this is a technology, but how can we apply that technology to solving for, unique customer problems?
I'd actually never thought of it this way in terms of open banking being a bad name. But some practical example of what we saw was at that time, so open banking required issuers or banks in Europe to share their transaction data with third parties, right? And that required them to build a lot of APIs, public APIs that we used to call them PSD2 APIs here. And those data had to be made available. And I know banks, interestingly, actually put an effort to build two kinds of APIs. One that they had to share with everyone, which was lower quality and just meeting the compliance. And the second version, which was a partner API, which they wanted to share only with the partners which are working with them, right? So there was a clear intent to reduce the quality and just meeting the compliance mark, rather than accepting this and doing it more wholeheartedly with the intent. So I guess it's in the naming, but the messaging around this has to be relooked at as well. That why is this happening?
Yeah, that's such a good point. And Ruth, I want to give you the kind of final word on this one. Who do you think is likely to be the biggest winner from these proposed regs? I was seeing quite a lot of articles online saying that mid-size and community banks in the US could actually find their time to shine here with their kind of focus on customer centricity if they do the implementation piece that Navi was talking about properly. What do you think?
I think the complexity is that there's a lot of competition for amazing tech talent. And so how do you make, as a sort of mid-sized community bank, how do you make yourself an interesting destination for someone with technology talent and sort of strategic tech insights to come and innovate? I certainly think that anyone who avails themselves of kind of new regulatory tailwind is in a position to, advance their business. The question is really around change. And I think that's why the Stripe story that we talked about earlier in the show feels so interesting. It's like, are you willing to make a really big investment in what you believe is the future? Or do you kind of continue to do things the way that you've done them before because inertia is easier and you're working in slightly longer time horizons? So I think it's going to be, entities that feel strongly about a point of view of what the future of banking should look like, and hopefully will avail themselves of these opportunities to better serve customers.
Yeah, 100%. And we'll definitely be keeping an eye on it. And equally, if you would like to read our report on the success of open banking in the UK, just visit 11fs.com/open banking report. I'm going to move us on to the next story, which is that fintech funding bucks the downward trend across Europe, helped by Gen AI. The story was in Finextra. So innovations in AI and embedded finance have kickstarted a recovery in fintech funding, according to Q3 figures compiled by Dealroom. While European startup funding faltered in Q3 2024, with startups raising a total of $11.3 billion, this was down 35% compared to the same time last year, but fintech bucked the trend, recovering from the 2023 downturn. Funding for fintech startups increased by 45% year over year in Q3, reaching $1.6 billion. And AI technologies continue to be a driving force in the European startup landscape. Generative AI in particular has attracted a significant investor interest, with $165 million raised across all sectors in Q3. Ruth is our resident investor in the room. I'd like to come to you first on this. What are your thoughts on this? Gen AI has raised a lot of money this year. Is that a surprise? Would it be more surprising if that wasn't the leading sector?
I think that it would be really surprising if it weren't the leading sector. Absolutely. So I think this is kind of one of those good news but bad news stories where we're seeing, a general decline in funding, investors pulling back and retrenching. Europe is always a place where investors are they blow hot and cold. There's questions about exit potential and sort of the valuation of these companies being sustained and where investors and founders go for liquidity. Gen AI certainly pulling in a lot of money. I think here we're seeing also these very large concentrated rounds. So, if you think about venture investing generally, it's like, well, OpenAI raised $6.6 billion. That's kind of a lot of money. But then, when we see these very, very concentrated large rounds, it doesn't say that much for the sector generally, except what we already know about venture, which is venture is a game of exceptions. There's massive bifurcation. It's a story of haves and have-nots. It's a power law distribution. And so in some ways, I think it's to be expected. Investors are really betting on generative AI as a new platform. And they're betting on fintech and the financial services vertical as a place where there are still really big problems for technology to solve or innovate.
Yeah, absolutely. And I'm interested in your earlier point around investors blowing kind of hot and cold on Europe. Why is that in particular? Why do they kind of have a moment and then back away again?
I think that what we know about Europe is that there are some really amazing educational institutions where people can do really innovative things like build large language models and, attract really interesting talent. But there's just aspects of the European markets and of the market structure which feel limiting around the size of a business that can be built. The majority of capital and venture capital comes from US funds. And so there are moments where US funds are flush with cash, valuations become really, really high in the United States, and people say, oh, let's get some arbitrage by going and investing in, these types of companies in Europe. That'll be great. And then as soon as there's a sort of scare or a bubble burst or there's a repricing in the market, these same investors are like, how much do we really know about these markets? Was that really a good idea? I don't know. Let's get our person in London back home. And so, it's just kind of the vicissitudes of the market. I don't really take these types of ups and downs seriously ever because it's all very cyclical. And venture investing is about, 10-year time horizons.
And as you were saying, like the UK has taken the most funding in Europe. Germany is then second with 2.7 billion, which is apparently 6% up on last year. France is third, which is down from last year. And the Netherlands, Italy, Belgium, and Ireland have all seen an increase in investment there. Ross, is that a surprise? Is that the kind of hierarchy you would expect? Any kind of new names in there that you wouldn't expect to get this kind of investment?
I mean, being Irish, I'm pleased to see Ireland in there, but I expect there are some favourable conditions that have been set by the government that are maybe helping to drive some of that. Although, not to diminish it entirely. I mean, it's got great links into mainland Europe. Everybody speaks English, good relations with the US, access to a well-educated, talented workforce, all of that sort of stuff. Largely, I mean, I think it's the hierarchy that we'd expect. What I think is interesting from Ruth's point, though, is we do a lot of these kind of stories, I suppose, on the show where we see spikes and peaks, and I know we tend to zero in on investment, particularly, look, a few years ago when fintech was going such great guns, particularly in the UK, and of course then, there was a downturn in sort of market conditions. There was fintech funding dried up as a result, and of course we saw some consolidation, some of those businesses leaving the market, and we've also seen a real race to profitability. And now you look at some of the more established fintechs that have come out the other side of that, the Revoluts, the Monzos, and they're stronger for it. I think it's an interesting time, Ruth. I think your word retrenching is exactly right. It feels like we're sort of looking for that next big opportunity to invest in, and Gen AI is definitely the on-trend thing at the moment. And Ruth, to your point as well, I think that's because there are so many applications and so many problems that it can solve, none more so, I suppose, than in the financial services space.
And also, I think what was interesting was that early and breakout stages are seeing the most stability, where late stage investment has declined. Obviously, in previous years, it was the reverse. So all the early stages weren't getting a huge amount of investment, but like the big fundraisers were just getting boosted and boosted. Why do we think that is? Is that part of the Gen AI factor and that being a kind of nascent industry? Navi, do you have any thoughts on that?
Yes. Like any new technology that comes in requires a lot of investment at an early stage, right? But just to touch on what Ruth, you brought up, being hot and cold, I think I can share a couple of views personally on what we experience, right? At Minna, at least. So when you look at the US market, we often joke in the entrepreneur community that it's the world's largest market you can actually monetize, right? And when you look at Europe, right, geographically, you may say that it's big, but the markets are very different from each other. Like France is different from Germany, is different from Italy, is different from UK. So it's not that you get into one and you have access to the whole market. And most of the large financial technologies companies, I'm not saying all, obviously Revolut and others have proven it, right? But for most tech companies to scale, they eventually do have to go to the US markets, right? And when the economy is right, it does make sense for funds to back those companies. But when it's not, right, that's where, that hot and cold behavior comes into picture. And as a business, I can understand why, because being in Europe doesn't necessarily give you access to the whole Europe, right? Just because the market dynamics and the buying behavior is completely different, and they're much smaller geographies with different languages.
Yeah, that's such a good point. And Ruth, I want to give you the final word on this. What does this mean going forward? Is it a good sign for 2025's kind of investing ecosystem?
Nobody knows. I mean, I think that it's hard to predict. I think there's always going to be money for great companies, and it feels like there is really a lot of opportunity, and that we are seeing some pretty big and important platform shifts. And I think that my sense is that investors are warming back up to being out there. And, we've got a bunch of instability in the world right now, which of course it could always turn markets on a dime. We've got elections coming up in some pretty important places, and we've got a few wars going on. So I try not to predict the future, but for right now, I think that there is a lot of optimism for the future of emerging technology.
And that is a good point to end the story on. So thank you for that. Okay, now for a quick look at two more news stories this week that we didn't have time to cover in full. The first is that Wise joins Japan's domestic payment network Zengin, or Zengin, I'm not sure. From Fintech Futures, the UK-based money transfer firm is the first non-bank to do this. This means that Wise, who have been operating in Japan for over 8 years now, can process real-time payments directly in the country without needing middlemen. This is potentially a huge deal for both businesses and individuals, especially for cross-border payments. The move comes after Wise's Japanese arm was licensed earlier this year, allowing customers to send and receive up to 150 million yen per transaction in over 40 currencies. That's just north of £750,000 or just shy of $1 million for our American friends. It's another big step for Wise in their mission to make global money transfers faster and more seamless, especially for people and businesses dealing with Japan. Russ, what was your thoughts on this?
Well, look, it's great. I mean, it opens up a new market for Wise, which is really exciting. I spoke a little bit earlier on about the correspondent banking model, how we've traditionally remitted monies across different countries, and just the frictions, the expense, the time. So I think anything that can offer that service, but in a much more seamless and more time and cost effective way, I think is really, really good. So yeah, great story. Like really exciting. Let's keep an eye and let's see where it goes. All right. Well, look, our next story, Laura, HSBC lets international customers use overseas credit for mortgages. This one comes from FS Tech. And it's pitched as some good news for international home buyers. HSBC has partnered with Nova Credit, who translate international credit histories into a format that works for UK banks, so buyers don't have to do all of the legwork themselves. It's a first for a major bank, and it will save foreign buyers the hassle and cost of sourcing and translating their credit reports. The whole thing's automated and in English. The service is available for non-residents from countries like Australia, the USA, and Switzerland, as well as for people who've moved to the UK within the last 12 months from 14 eligible countries. HSBC has already teamed up with Nova Credit for credit card applications using international credit history, but now they're expanding this partnership for, with apologies to our mortgage friends, everyone's least favorite area of FS. Laura, what do you think of this one?
I think much like the last story, like this is a good news story that's just making things easier for people. And obviously it's particularly good news for international residents looking to get a mortgage with HSBC. Sort of, as you said, customers from outside the UK previously had to source and translate their own credit reports before applying for a mortgage at obviously cost to themselves and with a huge amount of time involved as well. We've said many times at 11FS that the home buying process is broken, it's cumbersome, it's far too analog and just generally slow. This is made worse if you're not a national resident because you've got more hoops to jump through, paperwork to provide, so anything that speeds that up has to be a good thing. And great for HSBC to shout about being the first to do this. I think it'd be interesting to see who might do the same and make this easier generally going forward. And finally, a look at something a bit more lighthearted from the world of business. Bruce Springsteen says that paying his band, quote, a tremendous amount of money has been the secret to his success and longevity. This was in Business Insider. So Bruce Springsteen just got real about the keys to his success at a screening of his new documentary in London, and his big secret, paying his band well and being a pretty nice boss. He joked that paying his band a tremendous amount of money keeps things running smoothly, but also emphasized the importance of casting the right people and always performing like it's your last night on Earth. His documentary is all about the rewards of keeping a band together, which, according to Bruce, is rare. Most bands break up, but the E Street Band has been rocking since the 70s. With hits like Born to Run and Born in the USA, Springsteen's career is legendary. He's sold over 140 million records, won 20 Grammys, and is reportedly worth over $1.2 billion. Firstly, any Bruce fans on the panel?
I'm personally from New Jersey, and I am a big fan of The Boss.
Fantastic. And so, has The Boss cut to the core of how to keep employees happy? What do you think?
I just feel like if you get to be in the E Street Band, you're probably one of the luckiest people in the world. So I refuse to believe that it is purely financial. But, fairness is a super huge, important value. The Boss is really tuned into, what makes humanity tick. So listen, if he's selling it, I'm buying it.
And really, his advice, Navi, kind of comes down to pay people well and be nice to them. That sounds like a pretty good policy, right?
As simple as it gets, right? But yes, pay people well, give them, I think the purpose is very important in what I see, especially in tech companies, right? It's very important to pay people well, but also make sure when you're competing with larger companies, which have much better benefits, it's also about purpose. What's the bigger picture we're trying to build? So, but yes, fundamentally, pay people well and they do the job.
Russ, what are your thoughts? Can we learn anything from The Boss about how to keep the band together for 50 plus years?
Yeah, I think so. I mean, look, I love Bruce Springsteen. I've seen him live. It was probably, I think it was the best show I've ever seen. And, Laura, exactly to your point. I mean, treat people well, reward them well, and they'll be happy and they'll go into battle with you. I think, the bit that we shouldn't forget, I mean, I haven't seen the documentary, but I know certainly in his early days, Bruce Springsteen was just a complete perfectionist, one of the most demanding artists in the studio. I'm sure one of the most demanding of all of his band members. I'm sure it wasn't always a walk in the park, but I think giving them the credit, it's not just Bruce Springsteen, it's Bruce Springsteen and the E Street Band what I think is interesting is lots of them are famous in their own right. You've Niels Lofgren, who's a great sort of session musician. You've got, I think, Max Weinberg, the drummer, who's famous for like the late night TV shows and all of that sort of stuff. But yet they all come back because they clearly, they love the thrill of it. And so...
Well, Stevie's on The Sopranos.
Yeah, exactly. Right. Exactly. But there's something about, working with Bruce, all getting together, that they all love. And so I think it's treat people well, reward people well, and also just like, high performers, like set the right culture, challenge people. I think it's a lot. I think there's a lot in there.
Look at you bringing the Bruce knowledge to the podcast.
Listen, I told you I love him.
I appreciate it. But yeah, I think, you're right. It's obviously, treat people well and pay them appropriately, but it's also like set standards. Like if he was that perfectionist and his band have stuck with him, like they obviously appreciate that level of standard and that's what they want to work to as well. So it is kind of like laying out how you want things to go as well. What do you think, Ruth? Does that mean that the documentary is going to become a must-watch for aspiring CEOs as well as Bruce fans? Is there much we can learn from the boss here?
I'm very excited about the documentary, so I will be watching it.
You will be watching it. Russ, you're presumably going to be watching it.
100%.
Yeah. Navi, maybe there's some Bruce education you need here.
Under peer pressure, I have to watch it, but I'm pretty sure it will be good.
Is it too late for him to run for president?
In time for 2 weeks' time?
He might win.
Yeah, maybe. Maybe if not this time, maybe next time. I guess he has to retire eventually, right? So yeah, although not that running for president is exactly the relaxing retirement he maybe had in mind, but you never know. And on that note, that wraps up this week's Fintech Insider News. And thank you so much to today's guests. Where can people find out a little bit more about you and your companies? Let's start with you, Russ.
Who said I want anybody to find out more? No, I'm joking. You can find me on LinkedIn at Ross Gallagher.
And Navi?
You can find me on LinkedIn, Navpreet Randhawa, and you can find about my company at www.minna.tech.
Lovely. Ruth?
You can go to foxcapital.com and you can sign up for our newsletter, Fox News.
Amazing. Foxe with an E?
Yep, Foxe.
Fantastic. And as for me, you can find me, Laura Watkins, on LinkedIn or 11fs.com. Thank you so much for listening. If you like what you've heard, please follow our podcast and don't forget to leave us a review. It helps us make a better show and helps others to find us. And if you really want to help us make a better show, you can do so by filling in our listener survey right now at 11fs.com/survey. And if you're listening on Spotify, you can now drop us a comment and tell us what you thought of the show directly on Spotify. As always, if you want to join the conversation, find us on social media. Just search for 11FS or Fintech Insider or email podcast@11fs.com. We also have a brand new WhatsApp community channel where you can get the inside track on all of our content. You can get involved via the link in the description below. Thanks very much and goodbye.
Whether you're starting or scaling your company's security program, demonstrating top-notch security practices and establishing trust is more important than ever. Vanta automates compliance for ISO 27001, SOC 2, GDPR, and more, saving you time and money while helping you build customer trust. Plus, you can streamline security reviews by automating questionnaires and demonstrating your security posture with a customer-facing trust center, all powered by Vanta AI. Over 7,000 global companies like Atlassian, Flow Health, and Quora use Vanta to manage risk and prove security in real time. Our audience gets a special offer of $1,000 off Vanta at vanta.com/insider. That's VANTA.com/insider for $1,000 off.